What if the Federal Reserve's biggest challenge is no longer inflation? What if the real test facing the new Fed chair is whether the central bank can remain independent in an increasingly political environment? Kevin Warsh has inherited an institution facing a credibility crisis, a slowing economy, and mounting pressure from Washington. The question now is whether he can navigate all three. On May 22, 2026, Kevin Warsh officially became the 17th chair of the Federal Reserve, but his appointment came after one of the most controversial transitions in Fed history. Months of political pressure on Jerome Powell, investigations involving senior Fed officials, and a razor-thin Senate confirmation vote raised concerns about whether the Federal Reserve could remain truly independent. At his first press conference, Warsh repeatedly emphasized one phrase: price stability. Inflation had remained above the Fed's target for more than 5 years. Markets interpreted his remarks as a clear signal that interest rates might stay higher for longer. The Fed's own projections reinforced that view. Policymakers revised their expected year-end policy rate higher and signaled growing concern about inflation risks. But there is another interpretation. Warsh may not be naturally hawkish at all. Instead, he may simply be responding to the circumstances he inherited. After all, he was appointed by a president who had spent months publicly demanding lower interest rates. Under those conditions, any new Fed chair would need to demonstrate independence immediately. In other words, the Fed's hawkish tone may have been as much about restoring credibility as fighting inflation. Perhaps the most important takeaway from Warsh's first months is that he appears less interested in choosing between hawkish and dovish policies and more interested in redesigning how monetary policy is made. He has questioned the value of forward guidance. He argues that when markets simply react to Fed forecasts, policymakers lose valuable information embedded in market prices. To demonstrate this philosophy, he became the only Fed official not to submit a personal interest rate projection. At the same time, he launched a broad review of the Fed's decision-making framework, including the use of artificial intelligence, real-time data, communication strategy, and inflation analysis. While markets focused on inflation, recent economic data began telling a different story. The June employment report showed payroll growth of just 57,000 jobs, far below expectations. Previous months were revised lower. Labor force participation also declined. The result was a weaker dollar and falling Treasury yields. Investors suddenly began to question whether the economy was slowing faster than expected. Ultimately, Kevin Warsh's success may not be measured by inflation alone. The bigger challenge lies elsewhere. The United States faces rising debt levels, persistent budget deficits, and massive investment needs in technology and artificial intelligence. Against that backdrop, long-term interest rates could become the most important variable in the economy, and they may also become the ultimate test of Federal Reserve independence. The market's biggest question is no longer whether Kevin Warsh is hawkish or dovish. The real question is whether the Federal Reserve can maintain its credibility and independence in a world where economics and politics are becoming increasingly difficult to separate. Stay tuned. If you found this analysis useful, please consider liking the video and subscribing to the channel for more insights on global markets, macroeconomics, and investment strategy. Thank you for watching.